Good afternoon, everyone. Thanks for taking the time to join us this afternoon as we go through CreditSights' second half outlook. My name is Pramod Shenoi. I'm the head of overall research and financial research at CreditSights for the APAC region, and I'm delighted to be joined by my colleagues Zerlina Zeng, Pius Xue, and R. Lakshmanan, who will also be covering different facets of the discussion this afternoon. So we have a lot to discuss. Before we jump into our presentation points, just some logistics and other matters. So on your screen, you have a live Q&A box. Please do feel free to add your questions as we get along. You should also see some research notes that we put up on this particular page. These are our second half and into next year outlooks, the implications in Asia, as well as our Asia Credit Best Ideas piece for July, which got released just yesterday. So today we're going to be discussing the CreditSights second half outlook, the implications for Asia. We're going to be running through some of our more recent initiations. There have been a lot of topical subjects around the credit markets. We're going to be discussing those, and then we move on to some thematic points. So with no further ado, let me move across to Zerlina. Zerlina, we've now just released our latest rates and markets outlook for the US and indeed Europe and Asia. What's it like, and what are the implications for Asia?
Yeah, thanks, Pramod. So among the global strategy team members, we joked that our weekly meeting now feels like the movie Groundhog Day, as the same market and trading dynamics repeat geopolitical noises, inflation and job data, AI and private credit worries, but all in the end give up to the very strong technical and good oil yield, and spreads are now back to year start levels. I think it's very wild that the US 10-year yields only traveled a modest 73 basis point range in the first half of the year, way below the long run average for first half, which is 116 basis point. So our outlook is already really this reflection of the tension between strong technicals and uncertainty realities. Our US strategy team now expect the Fed to be on hold through second half of the year and potentially into first half next year. We still think the bar is very high for hikes, even though the market now prices in 30 basis point of hikes throughout 2026. But we would not rule out this possibility if job growth continue to accelerate, even though the last print doesn't look so great. While the US-Iran peace agreement still faces uncertainties, oil prices are now below pre-war levels, which we expect to offer relief to monthly inflation prints ahead. With the new Fed chair launching task forces to reassess policy communication, tools, and data reliance, we expect the Fed to let the data play out over the near term. We project 10-year US Treasury yields to finish the year at the range of 4.3% to 4.4%. Our 10-year US Treasury target is roughly 20 basis point lower than the forwards, reflecting our slightly dovish Fed view. We look for the two stance curve to remain around 30 basis point, which is also modestly flatter than the forward imply, because we think the risk of front-end yields might rise in if the upcoming Fed meetings turn out to be hawkish. For the US credit, we forecast US IG and high yield spreads to remain tight at 85 basis points and 300 basis points respectively by year end this year, as elevated yields leave credits attractive, particularly for higher quality ones. Now, a very quick reminder to our audience, we are hosting an EM Sovereign and Corporate Outlook webinar next Thursday, 3 p.m. London time, 10 p.m. Singapore time. This will be joined by our head of EM Sovereign, Regis Schatzlia, and head of EM Corporates, Eric Vega, whose team has initiated a very good number of national oils, telecom, and metals and mining in LATAM region in the first half of the year. So you could actually find the registration link at the webinar console. Now moving on to the implication for Asia credit market, I think the first is this broadly and cautious positive risk sentiment. And because of this, we also expect Asia dollar IG credit to trade sideways around the current level of 60 to 65 basis points, which is 10 to 15 basis points inside the US and Euro IG spreads because of the solid market and credit fundamental of Asia corporates, limited new supply, and decent oil yields. I sometimes feel like a broken recorder because I keep repeating these three supporting factors, but they indeed played out in the first half of the year. Limited new supply will remain a very strong technical support for Asia ex-Japan dollar credits. Despite a surge of new issues over the past couple of weeks, Asia ex-Japan dollar new issuance year to date was still down 20%, and net supply was a negative 27 billion, as issuers tapped Asia local currency bond market and the euro bond market to diversify funding channels and lower costs. We estimate the Asia ex-Japan dollar primary market recorded about 27 billion of that negative new supply, and this number will further widen to about a gross supply of 65 billion, then the total negative net supply of 45 to 50 billion, which is even more negative than 2025. I think everybody knows the market is hating the spread, but at the same time love the yield. Year to date, indeed, Asia dollar IG yields have risen 37 basis points to its long-term average of 4.5%, and Asia dollar high yield yields have also risen close to 20 basis points year to date and are now around 20 basis points cheaper than US high yield. Lastly, for credit positioning, we continue to prefer a credit barbell strategy for APAC dollar credits. We like to own both short-dated defensive credits for safe carry and selectively going down in rating spectrum and capital structure for spread and yield pickup and market beta exposure. For investors looking for defensive short-dated carry, we prefer less than 5-year senior bullets of Korean quasis, Hong Kong conglomerate, and high-grade property names, as well as New Zealand bank seniors. And for IG beta plays, we like selected APAC corporate hybrids, Hong Kong bank tier 2s, and China NBFI. I think the individual analysts later will go through this in much more detail. And we also have this in our latest version of Asia Credit Best Idea for July. Lastly, in terms of duration, as our US strategy team now expects US core yields to remain elevated throughout the year, we would prefer maintaining duration neutral to the Asia dollar IG index, so around 5-year, while at the same time we would also looking for tactical opportunities to add long-dated paper when US core yields gap higher. Our preferred duration play remains Japanese lifer subdebt, A-rated China tech long end, and the largest Indonesian and Middle East quasi. So that's all from me. Back to you, Pramod.
Thanks, Zerlina. I'm not going to let go of you just yet. We also released our semi-annual sector snapshots. What do you recommend as far as sector positioning for the second half of the year?
Yeah, so in the first half of the year, our outperforming sectors, which are IG banks, gaming, and IG utility, did beat the Asia IG index in excess return by a quite wide margin. So kudos to these three teams. We still like these IG sectors. Asia IG banks continue to trade wider than the Asia IG index on an OAS basis, despite its much shorter duration and defensive profile. And our banking team thinks everything, the fundamental outlook is broadly comfortable. For IG utility, we see temporary earning pressure on selected issuers from elevated energy prices, but we expect their credit fundamentals to remain intact in the medium term, thanks to the regulated tariff regimes and solid government backing. For Asia IG gaming, we think the sector spread pickup versus the IG index is quite attractive, and we are constructive on the credit outlook of major constituents. Moving on to the flip side, our underperformed sectors did a bit better than our expectation, particularly Asia IG financials and the local authority sectors. I think a big driver is the continued tightening of Chinese AMCs and LGIVs due to scarcity. We continue to see unattractive relative value of these sectors. The trading liquidity of Chinese papers are also likely remain relatively poor. We also underperform IG basics. This is because we are cautious about softening petrochemical margins, mining margin pressure from energy cost inflation, and growing mining policy uncertainties faced by the Indonesian miners, which I think Lux will go through in much more detail for the Southeast Asian corporates, as well as the persistent rating downgrade risks. For the rest of the sectors, we maintain a market perform recommendation. These include the Asia IG, insurance, agency, auto, capital goods, consumer goods, energy, media, real estate, retail, technology, and telecommunications.
Thank you. Just as a plug for those who are subscribers, you'd see each of these sector snapshots have a very good overview of what to expect in the second half of the year, our preferred positioning, as well as what we expect from a supply perspective. So very useful to have that as a quick overview. It's also very useful for other sectors from other parts of the world. So in case there are topical sectors such as US telecoms or European autos, it's a quick way to get up to speed with what's happening on that particular sector. Thanks, Zerlina. With that, we'll move on to our recent initiation. So I'm going to start with Laksh. Laksh, you've had the opportunity to reinitiate on Japfa. Of course, the issuer is back in the market with an issuance from a different entity, as well as initiate on Danantara. So what are your views for these two credits?
Okay. Thanks, Pramod. We kind of took the opportunity since Japfa had returned to the market, albeit through its Singaporean parent company, Japfa PTE. We think we currently have a market perform recommendation on it since we initiated on it in early May. We see a few strengths in the form that the company has a very good market position in the poultry sector in Indonesia. It has vertically integrated operations. Its and leverage metrics currently are quite robust at under 2 times. However, having said that, we do caveat that it is a weak high-yield name, even at the parent level. It has exposure to volatile input raw material cost, namely corn and soybean. Its prices of poultry also tend to be very volatile. They are quite seasonal, and then it is very hard to predict in which direction it will take, as the Indonesian government also engages in some culling programs from time to time. It is quite exposed to the volatility in the currency, especially to IDR. Given these, and in addition to that, at the time of the new bond issue, we also highlighted that we are also concerned about growing corporate governance risk, as some of the financial initiatives seem to be in favor of the promoters or the parent shareholders. In this case, this is a Santosa family, which kind of was a little bit concerning. And in addition to that, it's the Vietnam business also is comes under the threat of swine flu, African swine flu attacks or outbreaks from time to time, which impacts the stock and impairs the earnings for that particular periods. With all this in mind, the company did come out with a fairly attractive coupon of about close to 8%, because of which, and despite the risk that we just highlighted, we think that it is fit for a market perform recommendation. We do not think there is a lot of spread compression potential left, but at the same time, the coupon is still fairly attractive, which kind of compensate the multiple credit risks that we still see in the company. Danantara is a very interesting story. We have been, that is quite well tracked by many investors, many of whom will also be on this call. The Indonesian macro continues to be of a hot topic, a lot of concern. One, because of the policy uncertainty, the governance risk, the risk that the fiscal deficit could balloon and exceed beyond the legal threshold of 3% with the many social welfare schemes. And also some of the moves by the central government, one of which was to remove the quite reputed or well regarded former finance minister, Sri Gulyani Indravati. There has also been some state interventionist measures in the form of the the state's intervention in the commodity market in order to control the sales from the commodity exporters within Indonesia and to the overseas market also. So with all this macro concerns in mind, we are kind of wary of potential sovereign downgrade risk. And that kind of risk also then spill over to Danantara as it is the sovereign wealth fund. And therefore, that is kind of what makes us quite wary of Danantara and also its issuer Danantara Investment Management. In addition to that, it has its own set of risk in the form that we do not think that it has an overarching independence in order to make investment decision. They could be subject to some form of political interventions from time to time. Secondly, there is these governance risk and also execution risk in order to deploy the large funds that it has raised or will raise in future, and it is to be seen if they will generate sustainable returns and those projects can be executed well. Having said this, the Danantara still remains a sovereign-backed entity, and that provides comfort. It has quite fairly good liquidity so far because of access to multiple funding channels. It has also forged partnership with various sovereign wealth funds and other entities that will enable to roll out its projects at a decent pace. With all this in mind, yet we are very much concerned about the various macro risks that we mentioned, and that we think will have overbearing weight on how the credit plays out in the near future, even in the medium term. And therefore, in general, we are quite cautious on the credit as a whole. And with the new bonds or the debut bonds pricing, we thought that it was a bit too aggressive, a bit too tight. So therefore, we didn't like it at that juncture. And we still don't like the Danantara's bonds. And therefore, we have them at an underperform recommendation. So that's where we are at. And that's how we have initiated on both high yield Indonesian main Japfa as well as the sovereign wealth fund Danantara. I'll pause here and hand it back to Bill.
Thanks, Laksh. And I'll turn next to Pius. And Pius, in the meantime, has initiated on Mongolia mining and Kyoshia. I think Pius was a little disappointed that S&P and Fitch jumped in and upgraded Kyoshia just before we came out with our initiations. But Pius, across to you to run through these two credits.
Sure, Pramod. Yeah, thanks. Yeah, so just as you mentioned, Kyoshia was upgraded to be investment grade to low BBB in late May by the Moody's and Fitch just before our initiation. But we initiate Kyoshia with the market perform recommendation, mainly considering that its outlook for 2027, meaning that the upcoming fiscal year is still rather constructive, primarily driven by the memory super cycle. But then the thing is that from a valuation perspective, especially I say from an RV perspective, it's 30s and 33 bonds trading at 100 basis points, 110 basis points appear to be fair versus its comps, which is SK Hynix and Micron, and also versus ADIG BBB index as well. But then we also want to mention that from absolute value perspective, all else being equal, we think that there's potentially another 20 to 30 basis points compression, potential compression, because we think that there's S&P might have positive rating actions on the company, just given that it's going to achieve net cash position in the coming quarter, and the gross leverage is going to come down a lot as well. So just a quick introduction to Kyoshia. So Kyoshia, it's a Japanese pure play NAND flash memory manufacturer. It's the third largest globally. It's a segment is marketed by its end customers. That's the data centers, the hyper scalers, um, and the server manufacturers and the PC and laptop manufacturers as well. So and just want to highlight also that 33% of this revenue it's from AI related demand, and the company is targeting 60% of such demand in the medium term. Want to highlight a few of the credit strengths. That's Kyoshia's technological leadership in the NAND technology, its capex efficiency compared to its peers, and its very strong banking and government relationship, as can be seen from historical development. Its weaknesses are obvious as well. It's still subject to semi-cyclicality, although the company is in the super cycle, as mentioned. And the NAND market compared to the DRAM market, which is the territory of SK Hynix and Samsung, NAND market is relatively more fragmented when you look at the competitive landscape. A few sort of key financials, key numbers to highlight. This is a huge company now. It's at the 280 billion market cap, and just to note that its market cap has risen by 35 times in the past year. Also, so just you can see that it's how this super cycle it's helping Kyoshia and its peers as well. And on a looking forward basis for this upcoming fiscal year 2027, we expect that its operating and the credit metrics to improve significantly on the back of a jump in the NAND ASP. Specifically, top line and EBITDA are gonna grow by 3 times and 5 times respectively. Its EBITDA is gonna get to $35 billion, which is 5 times versus the 7 billion seen in the last fiscal year. 35 billion, it's the upcoming fiscal year 2027, and it's going to be at 80% EBITDA margin. So we expect that it's going to reach net cash position in the coming in this quarter. That's the June quarter, and its gross leverage is going to go down to 0.3 times, which is below 1 time, which is S&P's upgrade threshold. So we do see that there's a potential positive rating action from S&P. And also one thing we want to highlight also is that yesterday we published a piece basically to share our thoughts on $880 billion investment push in the AI and semi sector by South Korea. So in this note, we share what this means most importantly for memory chip ASP, because that's the key rating driver for the semi names. And also we share broadly what the credit implication is, and also the bond supply implication as well. It's been pretty well read, so for our clients, please do go check it out. Okay, and then I'll move on to Mongolia mining quickly as well. So Mongolia mining, it's a completely different sector, completely different rating category. It's a single B credit. And we initiate Mongolia mining at a market perform, but with a positive skew, especially considering its fundamentals. It only has a one bond outstanding, 30s, trading at 7.8%, and then we think that it's at this point roughly trading in range, trading fair versus the low single B, the high single B, low double B commodity the peers. Considering its improving credit profile, but then it's balanced by some of the structural credit weaknesses, which we'll mention later. But then that being said, we will revisit our recommendation regularly on 2 key developments. One, it's a ramp up in its gold operation, and then secondly, it's any update to the sharing of mine economics with the government, as it's a developing event. quick introduction to the company as well. It's the largest private sector coking coal producer and exporter in Mongolia. It has been listed on Hong Kong Stock Exchange since 2010 with a market capitalization of 850 million. It's a small company. And it operates a vertically integrated mining platform, basically producing from 3 mines, 2 open pit coal mines, and 1 gold mine, which was just commissioned in the late last year in September 2025. So for 2025, the majority of EBITDA, 94% of EBITDA, is contributed by coal. Gold is just 6%, but then it's going to pick up. A few of the strengths to highlight is that its coal has quite long reserve life, very low cost production, and as I mentioned just now, we are seeing improving diversification from the ramp up in operation in the gold segment. A few structural weaknesses as well. Its exposure to commodity cyclicality, its small size versus global peers, and the demand concentration from China. Almost 100% of demand is from China in the coal segment, and also the sovereign and regulatory risks in the sector and also in the country in Mongolia. So on a looking forward basis, we see that the 2026, 2027, the company is going to recover its financial from the low point in the 25, and this is supported by the ramp up in gold operations and the strength in the coal price in the first half this year, and also the normalized capex after the gold related development capex in the past 2 years also. For the gold segment's contribution, its EBITDA contribution, the gold segment is going to increase from 6% in the 2025 to 45% in the 2027. So that's the key, the bottom line, the driver. And we expect that the 26 EBITDA is going to go up by 73% to 350 million, and its total debt to EBITDA ratio is going to go down to 1 times from 2 times last year. And we expect that its rating is going to be likely going to be stable. It's there's going to be upside from incremental contribution from gold, but then the thing is that it's going to be capped by some of the structural weaknesses, as mentioned just now. Yep. I will stop here.
Thanks, Pius. I'm going to take 2 words that you've said, Mongolia and gold, and highlight that today we put out a note on Capri Global, which is a non-bank financial institution. They're going to be in the market next week. So we put out a note just highlighting the main credit points. The relevance with gold is that, like a lot of Indian non-bank financial institutions, they're more than 50% of their loan exposure is to gold. And the second point is around Mongolia. So you got Trade Development Bank in the market. We will be putting out a similar credit overview note and then wait for the RB to come out before we put that out. Great. Thanks for those initiation updates. We'll move on to the next segment, which is topical subjects. And Zerlina, I'm going to get back to you. You've been doing a lot of travel across Asia, meeting clients across a number of different jurisdictions. So what do you take away from these discussions?
Yeah, thanks, Pramod. So actually, our whole Asian research team has been traveling across the region, meeting investors in Asia and global fixed income markets. We have been to Hong Kong, Taiwan, mainland China, South Korea, Australia, Philippines, Malaysia. Did I miss anything? Oh yeah, and Pramod was also in the Middle East, and we were very relieved that he was back before the war. So I think the top question among the investors is always what other investors are doing. So I will share a few top observations. The first one is about fund flow. The biggest new money that we're seeing in the APAC region in the hard currency dollar space is really the onshore Chinese money. Over the past 2 years, Chinese authorities have broadened the official cross-border investment channels for both retail and institutional investors through an expanded QD, Southbound, and Wealth Connect programs. The reasons are onshore liquidity is flushing as banks find it hard to distribute loans and yields are extremely low. Chinese onshore fixed income managers now are struggling to even return 3% to investors. The Chinese new money are driving spreads tight in APAC dollar bonds, particularly China and Korea papers, Japanese and Australian financials, and they are, in my view, the biggest incremental flow into the AUD bond market. The second observation is the intense competition between equities and fixed income, particularly in markets such as South Korea and Taiwan, where equity markets are shooting to the moon on the back of AI optimism. In Korea, onshore retail and institutions are taking profit and reallocating offshore fixed income investment to onshore equities. Meanwhile, leveraged equity funds in Kospi index are tightening onshore Korean won funding and sending cross-currency points to negative territory, which works favorably for Korean corporates issuing offshore dollar bonds, then swap back to Korean won. As a result, Korean issuance is up more than 30% year on year, year to date to over 40 billion US dollar. Third one is in terms of client and investor positioning. I think so far the most crowded space is still developed market financials, Japan, Australia, European and US bank seniors for bank books, and capital instruments for PBs and other accounts looking for yield. As a result, more investors and our clients are asking us for trade ideas of diversifying into corporate issuers. Corporate hybrids are one area with strong client interest, particularly Euro, US, and AUD utility hybrids. EM corporates, especially Latin national oils and metals and mining players, which are viewed as a beneficiary of the higher energy prices due to the war. And due to policy rate uncertainties, floating rate notes are also gaining traction alongside loan and structured products such as US Euro triple ACLOs and OCR MBS. Diversification remains a central theme in many clients across markets and currencies, which brings the continued strong bid for Asia local currency bonds, including AUD and CNH markets. Lastly, AI data center bubble and private credit risks are still the biggest worries of most investors that we have spoken with. And a quick heads up, our head of US macro and US IG strategy, Zach Griffiths, will be in Taipei and Hong Kong week of 20th July, alongside our Asian senior analyst, hosting roundtables and one-on-ones and bring our house views on everything you want to know about high yield data center issuance, AI overbuild, private credit risks and opportunities. So please do reach out to your account captain and our marketing team for logistics and signups. Yeah, that's all from me. Back to you, Pramod.
Thanks, Zerlina. And on the back of that, I'm just going to spend a couple of moments just running through what it is that we're seeing from a financials perspective across the macro space in Asia and the implications for the banking sector, also non-bank financial institutions and insurance to the extent that they are also there. And this is more versus our expectations at the beginning of the year. So a few different points over here. We going more from west to east, shall we say. We start off with the Middle East because we cover the GCC region from here. So we moved the Saudi banks tier 2 back to an outperform recommendation. We do like the tier 2s of the non-SNB banks. We think that the spread versus the risk considerations over here, you're getting to about 200 basis points for 10 non-call 5s, now slightly more 9 non-call 4s because some of them have gone by almost a year. So that kind of spread for the risk that you're taking is very high quality. We don't expect the Middle East situation to explode again. Of course, famous last words, but everything else being equal, we think it's a good opportunity to step into in case you do have the ability. For Sing dollar-based investors, you have Riyadh Bank as well, which is in the Sing dollar market. The spread between that and SNB is very large. So Riyadh could be a possible opportunity as well. Moving on to India, we moved most Indian banks to a tactical outperform recommendation. This was on the back of the recent spread widening. So we have seen HDFC, Power Finance, Axis Bank in the market, and each one is pricing wider than the other. We think that this is uncalled for. Yes, there might be some amount of supply coming through, but it won't be humongous amounts, and it can be easily absorbed by the market. we do think that therefore it's an opportunity to step into these banks, and although there will be some amount of issuance in the near term, it's good to step in at these particular levels and watch them tighten by 10, 15 basis points. So we have put many of the names on an outperform recommendation. We did change, looking at the non-bank financial institution sector, we have outperforms on Muthoot and Manappuram only at the moment. IIFL, we moved yesterday to an underperform recommendation based upon its existing senior, and the senior that priced yesterday. We'd recommended that investors don't participate since we saw fair value at the IPT level. That's now widened to beyond where we saw fair value. So I think it's at about 4 point. It's beyond the IPT level, it's about the IPT level, about 7.85% at the moment. Moving on, Thailand, slightly better than we had been anticipating. And this dovetails well into our in our recommendations, because we have a market perform on Bangkok Bank and an underperform on Siam Commercial and Kasikorn. Siam Commercial and Kasikorn more affected by retail and SME, whereas Bangkok Bank doing better with its corporate exposure, and the corporate sector and exports sector in Thailand doing better than we had anticipated. Rest of Southeast Asia broadly in line with what we had expected. Korea is where we continue to be cautious. We're cautious for a couple of reasons. One, valuations are super tight. Secondly, is that the amount of leverage in the system, retail leverage in the system, at some point of time, if something goes wrong, then the securities houses and the banking sector might take some hits. At the moment, I'm sure that fee income is going to do really well. But the flip side of that is, with Korean won volatility, you do see some mark-to-market impact on the FX positions. So non-interest income might be affected. Two other jurisdictions to spend briefly time on, Japan and Australia. Japan, things seem to continue to be doing well, and we have outperformed recommendations of the mega banks. For choice, we prefer Mizuho, SMFG, and MUFG in that order. MUFG's recent low capital ratio buffer surprised us to the downside. Although it is something that they can make up in the near term, we're surprised that their capital management allowed the buffer to fall to just 50 basis points. In Australia, the news out of the economy is not a happy one, but the banking sector is doing okay. So we continue with our recommendations over there. We continue to see relative opportunity in the Australian Tier 2 space. So with that, I'm going to move out of my particular territory and move across to Laksh to pick up on some of the topical themes, more specifically Vedanta and some of the Thai SOEs. So Laksh, across to you.
Yeah, thanks. So Vedanta, as many would be aware, has been in the market since about close to a month. One for pricing newish bond issues, which is basically to fund its proposed tender offer for its 2028 and the 2029 bond. Simultaneously, it has floated tender offers for the rest of the 2030s bond, which are in 4 series. It also is accompanied by consent solicitations. So first up, when the consent solicitation for both the extraordinary resolution, one, which is related to the covenant resolution, and which we thought, and which many others thought was also much more significant and material, was to amend the optional redemption clause on the existing to all the way to par, which was a significant downside from where the current call prices were, and also from where the bonds were trading prior to all the deal announcement. Our recommendation was that they should provide consent to both these extraordinary resolution but not tender the bonds. The reason that we gave that they should not give their consent to only one of the resolution was that they might end up incurring a steep loss if the other bondholders provide the approval and that resolution gets passed, and in which case the optional redemption price on the bonds will see a significant markdown. So those bondholders who don't provide the consent to the second one, which is ER2, will not pick up any consent fee, but at the same time, they will see the bond prices on their existing holdings plummet sharply by about 8 to 12 cents on the order. So therefore, it seemed a safer and better option to provide consent to both the extraordinary resolutions. That way, they can pick up both the consent fee, which was quite attractive in the tune of about $8 to $10 for every $100 of bond. And secondly, they would be able to, if they do not tender, they can still kind of pick up the high coupon on the existing series of bonds. So the consent and the tender results have come out in the last few days or so. Essentially, the investors have not tendered a lot of the bonds in the 2030 series, which is in line with our suggestion. Many of the tenders are in the range of about 200 odd million for each series of bonds. As far the consents are concerned, even there, the investors have provided their approvals for both the extraordinary resolution, which again is ties in with our recommendation. So we are, in line, or it has played out in line with what we had expected. When it comes to the pricing when it comes to the new bonds that were printed, we think that the deal size was lower than what we had initially anticipated. The pricing was also weaker than what we had expected. Our fair value suggested that we saw it to be slightly even tighter than where it finally ended up pricing, to the tune of about 10 bip for the shorter dated 6-year bond, to as much as about 20-25 bip for the 8-year new bond. We see a few structural support for the new bonds in the form of security over brand fee, the amortization feature. They are quite well staggered in terms of how the bond repayments have been structured. Even though there has been an increase in the debt cap, it has been compensated by an additional subsidiary guarantor in the form of Vedanta Resources Mauritius too. So we do see that there is some structural support for the new bonds. So that's where we were coming in from, where we think that the fair value needs to be slightly tighter than where it finally ended up pricing. So those are our thoughts on Vedanta. As we mentioned that the consent solicitation results have come out, we will look to accordingly put out notes maybe early next week to reiterate our views on the Vedanta complex. The other part is on the Thai oil and PTTGC, which again is among the more topical within the Thai SOE complex as they face fallen angel risk. But about a week ago or so, Moody's has revised back its rating outlook on Thai oil from what was negative to stable. So we see that positively, as it hints that Moody's see there is some signs of deleveraging from Thai oil. There is better visibility and positive tone on the clean fuel project. And with that in mind, and in combination with the various deleveraging initiatives that Thai Oil took earlier this year in the form of issuing a PERP, there is better clarity that the fallen angel risk has diminished in comparison to what was previously there. While that seems to be the case, the PTTGC has diverged on the rating outlook. It still continues to be on a negative outlook by all three rating agencies, and we share that view, as its credit metrics has and still remains quite elevated, above close to or about 10 times. Its petrochemical sector is still under stress because of oversupply, and barring the Middle East situation that provided some green shoots of demand amid the shortage of supply. But yet again, on a sustainable basis, we still see that there is a lot of headwinds for PTTGC. So those are something that I would that I wanted to talk about, and that's still the Thai. These two names still continues to be something that we are watching very closely as their rating outlooks and their credit trajectories go on slightly divergent paths. Yeah, I'll stop here. Back to you, Prabhu.
Thanks for that, Lakshan. I'm just going to turn now to Pius to run through the MGM COC.
So the MGM China change of control event, potential change of control situation has been pretty topical in the last few weeks. And just a quick recap as to what happened. So MGM China's parent, which is MGM Resort, received a takeover offer on June 1st from its 26% shareholder, which is the People Incorporated, to increase the stake from 26% to the 50.1%. And since the event happened, we put out the two notes, and we had received many calls, many questions about whether the change of control on the MGM China level was triggered on the three bonds. And we received quite a bit of a pushback as to our view that at least for some of the bonds, the change of control was triggered. And our overall view is that we need to examine the three bonds. That's the 27s, the 31s, and the 33s separately, because they do have a different set of terms. Specifically on the 27s and the 31s, we think that the COC, the change of control, is trigger. And the way we look at it is that we need to look at this from a look-through basis, meaning what does People Incorporated, what its a takeover means on a look-through basis as to its beneficial ownership in MGM China, even though it doesn't hold MGM China directly, but then it holds MGM China indirectly through MGM Resort, which is the parent, the direct parent of MGM China. And our conclusion from this look-through examination is that basically People Incorporated becomes a beneficial owner of MGM China, because it passes the 50% line, and itself is not a permitted holder of MGM China. So therefore, the conclusion is that for 27s and the 31s, these two bonds specifically, change of control is likely happen because of the language. But then it's a different story for the 33s, which is the latest issuance of the complex. There is a carve-out language there around the concept of a HOCO. So it's subject to HOCO exemption. And what's interesting here is that People Incorporated, it's considered as a HOCO because it has diffuse ownership, whereby People Incorporated itself doesn't have any shareholder owning its shares more than 50%. So because of that concept, it's MGM China. It's not. It's 33s. It's not subject to. It's not subject to change of control, simply because of this HOCO exemption, where People Incorporated is not therefore a beneficial owner. So we do need to look at all these bonds differently. And what's interesting here, I also want to mention, is the trading dynamics for these three bonds. For the 27s, now it's trading at around a par level. So that's lower than the 101 change of control put. But then arguably it's trading at the right level because it's trading at a very tight level at a par, which is a 77 basis points spread. And also, there's only a few months away from the maturity, considering the uncertain timing of the transaction completion. And if the COC is trigger, and if COC put is in play, whether it can actually enjoy that the COC put and at what timing as well. For the 31s, it's trading at the 103.5 at this point, and that's primarily because of its very high coupon at the 7 and 1/8. So it's likely that even COC put it's eligible for the 31s, investor wouldn't put because of the high coupon. For the 33, it's trading at a 98 cents on the dollar at the right level, because as we concluded, it's not subject to COC. But then our view is that interestingly also we think that the market is pricing this bond at the right level, but then for the wrong reason. In the sense that the market simply thinks that okay, on the MGM Resort level, which is the parent of MGM China, because there's no change in its ownership in MGM China. So very simplistically, there's no change of control. But then the real reason, as we pointed out just now, the real reason of the change of control not being triggered is because of the HOCO exemption. Yep, I will stop here.
Thanks for running through that, Pius. So a pretty intricate case over here. Great. So we're going to, we started off with Zerlina. We're going to end with Zerlina. Zerlina, Aussie dollars, obviously very topical subject. Lots on in that particular space. What can you update us on, and where do you see the segment going?
Yeah, thanks, Pramod. Australian dollar is my favorite topic because we started recommending it end of 2024 and it has been performing pretty good. So last week we traveled to Sydney and Melbourne to meet fixed income investors and market participants across the AUD and global bond market to try to get what the onshore investors are thinking about the AUD bond market. The investors we met include domestic banks and asset managers, private banks, insurers, pension funds, syndicate DCM teams, market makers, and structured finance teams. So a few observations. The first one is Australian fixed income investors focus very heavily on the domestic market, particularly the AUD bond market. And they also agree with us that the market dynamics, breadth, and depth have improved very significantly over the past 2 years. Local investors think that AUD bond market was once dominated by, the benchmark size of 300 million only domestic paper of less than 5 year in tenor, but now the market can absorb very large, more than 1 billion size of deals, very long dated tranches, more than 10 year, and complex deals, including a lot of corporate hybrids issuance in both floating and fixed rate formats. Secondary liquidity remains less ideal than, for instance, US IG and Euro IG, particularly for domestic fixed rate paper of infrequent corporate issuers. But liquidity has also notably improved for the Kangaroo Financial and corporate notes because of a lot of participation from the increasing number of foreign market makers. And some are quite hopeful that the stricter tax treatment of investment property in Australia will channel more wealth into the AUD bond market. Most Australian investors expect AUD bond spreads to move sideways. This is one view we also shared because of very strong new supply and elevated AUD rates. They are a bit cautious on AUD duration, but I would say not overly bearish. Local syndicate and DCM teams expect domestic and kangaroo issuance to stay very strong over the coming months, which may become a headwind for higher beta sectors such as Australian REITs, corporate hybrids, and bank capital instruments. AUD bond spreads have compressed since we first started recommending the asset class to dollar-based investors looking for diversification in end of 2024. But I think they are still relatively cheaper than US, Euro, and Asia dollar bonds after adjusting for rating and duration differences. So one thing to note is AUD bond market has relatively short overall duration of just 4 years, also has a lot of floating rate papers, and the rating is at A2. It's probably the highest across the IG the fixed income markets around the world. Now, the AUD curve has flattened, reducing the carry for bank books, but remains deeper than global IG peers. Local investors are wary of sticky inflation, expect AUD rates to stay higher for longer, and prefer short-dated, less than 5-year, this type of paper and floating rate notes. But that said, I think they still prefer AUD duration over US and Euro duration, given the RBA has front-loaded 3 hikes this year, and the government has delivered a quite hawkish budget. And then in terms of the favorite sectors for Australian investors, these include the residential and industrial REITs. Interesting observation is year to date, they haven't really performed. I think one reason is a lot of the offshore investors, this is not the top sector for allocation, particularly for a lot of onshore Chinese money. Then onshore investors also like regional gas distributors, which we also think are very defensive names, and we like their hybrid papers, and transport infrastructure, utility hybrids among the domestic papers. And domestic investors also showed increased interest in kangaroo corporate issuers, which are typically priced outside their home currency curves. And lastly, I think one universal topic across all the APAC investors is really data center. This is also particularly of interest for Australian investors because Australia has become one of the Asia's most active market for data center and GPU financing, and a few operators are already exploring the region's first ABS financing. So overall, there's a lot of interest in our analysis of US high-yield data center deals and the comparison with the key modern area high-yield cycles, as well as some of our house views on medium-term data center oversupply. Yeah, that's all from me, and back to you, Pramod.
Thanks for that, Zerlina. And just as a reminder, Zerlina did point this out earlier in our discussions, but we have a full emerging markets discussion. This is an outlook for the second half of the year and into 2027 from Regis, our EM sovereign strategy analyst. Zerlina is going to be joining that discussion as well. And Eric Vega, who covers recently started covering EM corporates from a LATAM and Eastern European perspective. So do join that webinar. That's scheduled for 9th of July. Slightly late in the day our time, but a replay will be available. So with that, we'll wind up this particular session. Thanks for taking the time to join us, and we wish you a good rest of your afternoon and weekend ahead. Thank you.